So before the break, we were talking to Michael Whitney, and he told us why pig farmers were storing copper. Well, Nicholas Snowdon, commodities research analyst at Barclays Capital, says he expects copper to fall in the short term, but agrees with the pig farmers in the long term. He joins us now from our London newsroom with the take on that market. Why do you think that, Nick?
I think the sort of current dynamics in the base metals market in the short term are fairly weak. And the prime reason for that is that for the first half of the year, we saw Chinese import demand at record levels, and that was primarily driven by restocking along the supply chain in China, and also stockpiling by the government, by provincial governments, and by private individuals. But I think that sort of process and dynamic has come to an end. And in China, import demand is now just being driven by purely end demand strength. So the strength of Chinese import demand is likely to soften over the coming months. And although we expect OECD import demand driven by restocking and eventually end demand to plug that gap, as it were, in end demand for base metals, for the time being, we have a sort of grey period in the demand dynamic across the base metals. And I think that's why we're seeing a bit of price consolidation and indeed a bit of softness. So
if China ceases restocking next year, how different could things get?
Well, I think we're very bullish across the base metals complex. If Europe and the US start restocking and end demand improves, then that will definitely feed through into higher base metals prices. And I think copper is the sort of key, most bullish metal in that respect, particularly because on the supply side, copper has a very constrained mine dynamic. Mine supply in the key producing countries such as Chile and the US has more or less been flat over the past few years. And really, there isn't enough incremental mine supply additions in copper to really keep up with demand. And so we think over the next sort of 2 to 3 years, copper prices are really going to be very well supported. And indeed, our forecast for 2012 is for copper at $8,500. So we think there's a fair degree of appreciation to be seen from here.
Nick, where do the copper miners go to get reserves now? I mean, you're talking about in Chile, they're pretty much tapped out. They're going to have to spend more money in order to find more reserves. Where do they go?
Well, I mean, the sort of key focus over the past few years has been in the copper belt in Africa, in countries such as the Democratic Republic of Congo and Zambia. Those are where the clearest, most obvious reserves are, and the easiest to access in terms of mining. But, of course, those countries are also very difficult to operate in. They're landlocked, so it's very difficult to bring in equipment and very difficult to export the copper. And at the same time, politically and socially, they're fairly troubled countries, and so it's very difficult to operate there. So given that that's the source of incremental supply and very much prone to disruption and investment issues, it's a very bullish supply side dynamic for copper.
What about OECD demand? When do you think that's going to kick in?
Well, we think the OECD restocking cycle will begin over the coming months. In fact, it may have already begun. The nature of metals data means that it's retrospective, so we'll only know a month or 2 months in advance of what was happening previously. So there's a good chance that restocking cycle is already cranking up. If you look at the Eurozone and US PMI new orders indicators, it shows that those have really picked up. So we think with the very low inventory levels along the industrial supply chain, that restocking cycle is going to begin. And then we think, along the lines of our economists, that the OECD end demand will pick up as we move into 2010.
All right. Nick Snowdon, thanks for explaining all of that to us of Barclays Capital.
It was a pleasure.